Hey, good morning, everyone. Marty Missouri here, March 13th, 2022, with a technical stock market update for you. As promised, we're going to start keeping things shorter and more accessible to clients. We really want our clients paying attention to these messages amid what is a most volatile period for really assets across the board. So today I'm just going to show you two charts, one that I featured last week just to set the stage for one that I created this morning, and just to help you understand that from a technical perspective, things don't look good right now. Now, in the macro update that we released on Friday, talked about the fact that our macro assessment is that conditions right now are not recessionary, although the macro backdrop is slowing globally. Typically, big bad bear markets, as these red lines here suggest, these are recessions here, the last three, occur typically only during recessions. And again, so at least with regard to our PWA macro index, it's not scoring in the red. Therefore, the suggestion is that we aren't experiencing recessionary conditions, or that recession odds trump expansion odds for the foreseeable future. Having said that, it is a very volatile, of course, as you know, geopolitical environment that certainly has economic implications going forward. So where we're experiencing a score that otherwise would not have us hedging portfolios, we indeed are hedging against major downside risk and taking advantage of the commodities backdrop. With regard to the commodities backdrop, it has run very far, very fast, and whatever the catalyst, we do expect there to be some real pullback within our commodities exposure in the months to come. Long term, when you think about the inflation and commodity setup that we have really explored a lot over the last year or so, the Russia-Ukraine conflict exacerbates that, and not just on a short-term basis going forward. Last week, the European Union was proposing, a huge ramp up in both military and energy-related spending. Their goal is to, of course, reverse the energy dependence on Russia. And obviously, what's been happening currently does inspire nations pretty much across the board to ramp up on their military spending. This will demand massive investments in metals, mining, and refining. And frankly, the world didn't have the capacity to meet the clean energy mandates before the Russia-Ukraine situation. So think about the upward pressure long term on the commodity space, and in this conversation, the metals space in particular, going forward. So I think that's a position that we're going to have for quite some time into the future. Okay, so the two charts. The one on your screen is the study that I featured last week, and it's just the weekly chart of the NASDAQ Composite Index. And I showed that every time that it broke down through this 50-week moving average, and the 50-week moving average was rolling over, it went on to at least test the 200-week moving average. And we definitely have that look here. In fact, we have a bear flag pattern that had formed in here. And ironically, the next target lower based on that flag would put us right down about here on that 200-week moving average, which today is about a 32% decline in the NASDAQ Composite Index. So a ways further, according to this analysis, to go. And so what I looked at this morning was our monthly chart of the S&P 500 going back 25 years. And the reason I wanted to really explore that is because we now have a clear sell signal on the moving average convergence divergence. And again, this is a monthly chart, so each bar is 1 month. And then I went back and circled all of the breaks, all of the sell signals that have occurred over the last 25 years, and then assessed what happened relative to the 50-month moving average after that break. With one exception, in each occurrence, at a minimum, we tested the 50-month moving average. During the tech bubble recession, we'll call it, and the residential real estate / consumer debt recession that was the biggest since the Great Depression, Under those conditions, we actually went down a lot further than just the 50-week moving average. But every other time, with the exception of right here in 2006, which is just barely a sell signal, nothing concrete, you could almost argue that it doesn't deserve a circle. But aside from that one, anytime, even this very brief break right here, that we had a sell signal on the monthly MACD, either correspondingly or shortly thereafter, we went down and tested that 50-week moving average. Of course, here was the Great Recession. Had a sell signal, tested it here. Sell signal, just virtually tested it right there. Sell signal, tested it. Sell signal, tested it. Strong sell signal, very compelling negative looking sell signal. Big gap, fast drop, crash through the line. And so my whole point here, and let's zoom in on this, that if indeed this technical pattern plays itself out, then we're looking at from the peak right at the beginning of the year to where that 50-week moving average sits today is a 30% decline, and the S&P is down about 12. So this pattern right here says that we should brace for something more significant to the downside with the S&P 500. Of course, if indeed there is a resolution between here and there to the Russia-Ukraine crisis, of course, then this does not have to play itself out anytime soon. In fact, I think we'd see a very quick ramp higher in the S&P 500 and global stocks, in fact. If the Fed somehow decided that it can hold off on hiking interest rates and shrinking its balance sheet, that would be unambiguously bullish for stocks short term as well. All indications are the latter is not going to happen, that the Fed is going to raise interest rates by a quarter point this week. The announcement will come on Wednesday, and then confirm something along the lines of balance sheet reduction, and they give some insight into their thinking about interest rates going forward. Right now, Fed funds futures, I think, still discount about 6 rate hikes this year. A few weeks ago, the odds of a half a point increase were rising quite notably. That looks to be off the table at this point. So I'm not sure how the market's going to react. Chairman Powell tends to be very stock market oriented as he gives his press conference, and he's very, very careful, and it's not unusual to see big rallies on Fed days. So I guess that's possible this week. But clearly we're entering into a period of monetary tightening justified by inflation pressures. However, one could really argue or chastise the Fed that they are way late in the ball game and that they're now having to hike amid slowing economic conditions, which is not an ideal setup for equities going forward. So folks, again, despite the fact that we're not dealing with recessionary conditions currently, there are enough headwinds in front of this market that are being confirmed by the technicals that I'm showing here to have us investing outside of the equity market in things like gold and ag commodities and metals like we are, and then hedging against something major. And I need to emphasize something major. We are always going to be subject to corrections that are going to impact our portfolios if we're investing in a manner that is designed to beat inflation over the long term. But we do want to continue to play defense, to own these other assets that make a tremendous amount of sense, own parts of the world that make sense given the setup for commodities, etc. And then, spend some money via the options market to hedge against something really extreme to the downside, along the lines of, say, 2008 and the tech bubble back here. So folks, that's our story at the moment, which we think makes a lot of sense, but we'll keep an open mind and continue to crunch the data, the news, and so forth as we go forward. One thing that I can assure you of is that volatility is going to remain very high for the foreseeable future. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.